Did you know that your CPF Ordinary Account can do way more than just help you pay for housing? Let me show you how to maximize it for your future. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Firstly, what is the CPF Ordinary Account? The CPF Ordinary Account, also known as your OA, acts as a savings account designed to help you cover big ticket expenses. Every month, you contribute a portion of your salary into your three CPF accounts, with a major chunk of it going into your OA. Unlike other CPF accounts, your OA will be used for most of your major and important expenses in life, such as housing, education, and insurance. Now, before I dive further into these expenses, it's important to note that your CPF OA gives you a risk-free interest rate of 2.5% per annum. And to make it sweeter, your first $20,000 gets an additional 1% interest. This means that the government is making sure that your CPF OA catches up with the rising cost of living, making sure that you can afford these expenses when you're ready to buy them. Now, what can you use the CPF OA for? Firstly, you can use your OA for housing. Buying a home is one of life's biggest investments, and your OA makes it financially manageable. Your OA is a game changer when it comes to home ownership, and you can use it for down payments, mortgage repayments, legal fees, and stamp duties. You can also use your OA for education. Whether it's your studies, your spouse, or your kids, the OA can cover tuition fees at approved local institutions. Next, you can use your OA for insurance, and you can pay several essential insurance schemes such as the Integrated Shield plans for an enhanced hospitalization coverage, your Care Shield or Elder Shield supplements, which are disability payouts for when you're unable to perform the activities of daily living, your Home Protection Scheme, also known as your HPS, which is a mortgage reducing insurance that ensures your family keeps the home if anything happens to you. But one thing to understand about your CPF OA is that even though it's technically your money, you still have to pay back some of these funds. Think of it as a loan from your future self to your current self. This is because your CPF is meant to provide for you during your retirement, and whatever you borrowed from yourself plus interest will need to be returned so that you have funds to rely on for your retirement. So if you used it for an education loan, your OA funds will be needed to be repaid 1 year after graduation, and the minimum monthly repayment is $100. If you use your CPF OA for a property sale or a transfer, the principal amount withdrawn from your OA for the purchase plus any accrued interest must be refunded. If the selling price is insufficient to cover this, you generally won't need to top it up. Knowing this is critical, especially because when you just sold your property, you'll have to fork out cash to repay the accrued interest owed. I'll cover this more in a future video, so make sure to subscribe and hit the bell notification icon to not miss it. Another thing you can do with your CPF OA is to invest it via the CPF investment scheme, also known as the CPFIS. If you have at least $20,000 in your CPF OA, you can use the CPFIS to potentially grow your savings. Investment options you can use with this includes unit trusts, ETFs, government bonds, and even gold. You can also invest in stocks and certain property funds with some restrictions. So why should you invest? While the OA's 2.5% interest rate is safe, investing can help you achieve higher returns, though it does come with some risks, such as losing your capital. And if you do invest, make sure that your investments perform or outperform the 2.5%. Otherwise, you're just risking the 2.5% interest that CPF is giving you for free. Now, some Singaporeans transfer their OA funds into their special account funds or to your CPF retirement account if you're above 55. I'll be using the CPF SA to explain here, but the concept remains the same for both the special account and the retirement account. So, transferring your OA to your SA can significantly grow your retirement savings because of the higher interest rates offered by the CPF SA. Your SA earns up to 5% per annum compared to the OA's 2.5%. Transferring your SA will also boost retirement payouts, as a larger SA balance means higher CPF life payouts in retirement. While both of this might sound good, there are trade-offs involved in doing so. Firstly, there will be less flexibility. So once you've transferred your funds from your OA to your SA, it cannot be used for housing or any purposes mentioned just now. Next, you have potentially lower tax relief. So if you're topping up cash to your SA for tax relief, transferring funds from your OA to your SA will now limit how much tax relief you can get, as there is a transfer and a top-up limit. Transfers are also irreversible, so think carefully about your financial needs before making this decision. So we've covered how to maximize your CPF OA, from understanding its role in your housing and education to exploring investments, transfers, and even refunds. If you're unsure about your CPF strategy, feel free to reach out to our trusted financial advisors for personal guidance. I'll make sure to include the link in the description below. If there's a topic you'd like me to cover next, drop your suggestions in the comments down below. If you enjoyed this video, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching, and I'll see you in the next video.